Hello everyone and welcome back to the channel. I ran a poll on my channel 2 weeks ago and asked you which stock you want me to review, and majority of subscribers chose Dollarama. So in this video I'm going to analyze Dollarama stock and try to estimate the fair value of the stock using Yara IQ discounted cash flow calculator. Dollarama trades at an all-time high share price and the stock returns were absolutely remarkable. Dollarama is up 40% in the last year, over 280% in the last 5 years, and almost 600% in the last 10 years. It's completely outperformed S&P 500 and S&P TSX indices in the same time periods. Discount retailers like Dollarama often thrive in various economic conditions. During tougher times, consumers flock to them for value. In good times, the consumers still appreciate the discounts. So Dollarama has carved out a significant niche in Canadian retail landscape, and they are actually expanding their business into other parts of the world as well. Dollarama, founded in 1992, has grown from a single store to over 1,600 locations across Canada, almost 600 stores in Latin America, and almost 400 stores in Australia. Their business model is straightforward. Offer a wide range of everyday essentials, seasonal items, and general items at attractive price points, primarily focusing on items priced up to $5. This simple yet effective strategy has resonated very well with Canadians and international consumers in the last couple of years. Now, let me use Yara IQ Stock Analyzer to look at some of the numbers and charts for this stock. Dollarama was able to grow their revenue by 11.5% annually in the last 5 years, while their operating cash flow grew by 13% and their free cash flow grew by 12% annually in the same period. They also buying back their shares, and their shares outstanding reduced by 1.5% annually in the last couple of years. The business has a fantastic profit and operating margins at 18 and 25% respectively, and a free cash flow margin of 21%, which is great. In addition to these nice margins, the capital allocation of management team was legendary in the past couple of years. They have almost $4.8 billion net debt on their balance sheet, but the business is very profitable and generates $1.4 billion in free cash flow each year. Now, let's talk about the competitive landscape. Dollarama's main competitors in general merchandise and gadgets include other dollar store chains like $.to and online retailers like Temu and Amazon, and the discount sections of larger grocery and general merchandise stores like Walmart, Canadian Tire, and Giant Tiger. However, Dollarama's extensive store network and the supply chain efficiency gives them a significant competitive advantage. Dollarama is known for its efficient direct sourcing model, largely bypassing intermediate resellers. This allowed them to maintain healthy margins even on low-priced items. They have a proven ability to source these products cost-effectively and pass those savings on to the consumers. They cover a unique retail space as they focus on super low-cost items like kitchen accessories, toys, gift boxes, and gardening accessories that will be very hard to deliver as cheaply for the added shipping cost for larger retailers like Amazon, Walmart, and Costco. So I don't think Amazon, Walmart, Costco, or even discount retailers like Temu will cut into Dollarama market. And I actually think the customers of Dollarama will buy their products even in a recession, as people will want to shop and buy cheap products all the time. What about growth opportunities? Dollarama isn't just sitting still. They continue to expand their store count. They plan to have 2,200 stores in Canada, 1,050 stores in Latin America, and 700 stores in Australia by 2034. In addition to new stores, they have been innovating within their existing stores, for example by introducing a wider variety of price points beyond the traditional single dollar up to $5. This allowed them to offer a bit more premium products and capture a larger share of consumer spending. In terms of the valuation, Dollarama definitely trades at a premium valuation. This is actually the deal breaker when it comes to Dollarama. It trades at 44 times its earnings, 39 times of its free cash flow, and 33 times of its operating cash flow. Even compared to historical values, Dollarama trades at a premium compared to its own price to operating cash flow and price to earnings. Now, let's try to find the fair value of Dollarama stock using Yara IQ discounted cash flow calculator. To start building the model, I imported a series of general parameters from Dollarama stock from Yara IQ stock analyzer, like the current share price, their revenue, their number of shares, their net debt, and their operating cash flow per share. I also put my expected rate of return to be 12% for this stock. Now, in this model, I will calculate the fair value by projecting their future operating cash flow and then discount the terminal value and future cash flows minus the liabilities of the company back into the present value of the stock based on 3 different scenarios. In the bear case, or the most negative case for the stock, the business will have a little bit of margin compression. I consider them to have 0% share-based compensation and share dilution, and be able to grow their revenue by 10% in the short term, 8% in the midterm, and eventually by only 6% in the long term. And I consider a terminal multiple of 20, which is in agreement with historical bear periods of this stock. For base case or normal case, I considered a margin which is in line with their historical average, a bit better revenue growth, and a terminal multiple of 25, which is historically an average multiple for a similar stock. Finally, in the bull case or best possible outcome, I considered a little bit profit margin expansion, a 14% short-term, 11.5% midterm, and 9% long-term growth, and a terminal multiple of 30, which is a bull multiple for this company. Now, if I hit calculate, the software will give some valuable information about this stock based on my assumptions. It gives you the intrinsic value of the stock in each scenario, and then it will provide you with a fair value estimate, which is around $171 per share for Dollarama. And comparing to the current share price, Dollarama trades at 15% premium today. It is not a buy according to the model, but it is not super expensive either. I made a mistake with Dollarama in the past and didn't buy the stock, but I am fine with that. You can't win them all, and there are some opportunities that you have to let go if it is not in a price range that you're comfortable paying. Overall, I personally would not buy the stock here, but I think it can be an attractive option if the share price drops below $150 per share. If you want to have access to all these tools like discounted cash flow calculator and a stock analyzer, you can sign up for my Patreon, and for only 14 Canadian dollar per month, you will get access to all of these tools within Yara IQ, including a stock analyzer, portfolio manager, discounted cash flow calculator, and legendary investor tracker, plus my buys and sells in real time, my brand new Patreon portfolio in which I'm building a new portfolio ground up and I am buying new stocks each month within that portfolio. And you will also get access to my private Discord group where we discuss new investment ideas. So, what's the verdict? Dollarama is a well-managed company with a strong track record and a resilient business model. It offers investors exposure to a stable, growing retail segment, but the stock trades at a premium compared to its fair value. For long-term investors looking for a defensive play with consistent growth, Dollarama could be an attractive option, even at premium valuations. There you are, guys. I hope you enjoyed the video. Remember that this video is not a financial advice for you to buy, hold, or sell this stock, and you should always do your own research before making any financial decision. Thank you for watching, and I hope to see you guys in the next video. Farewell.